In this chapter, we're going to review corporations. It's important to understand some of the terms that go along with corporations so that you really understand the benefits and disadvantages of having a corporation. So make sure you go through, define all of these terms, and understand where they fall. Are they an advantage or a disadvantage for the corporation? And then we want to understand what a shareholder is. So corporations issue shares of stock, and anyone can buy those. And as soon as you buy a share of that stock, you become an owner in that company. So these owners have rights. They have voting rights. So they can vote on any major thing that the company is trying to do. Shareholders also get to share in the earnings of that corporation as owners. They share these earnings through what we call dividends. And we'll go through what dividends are and how to record those in a bit. The third thing that falls into shareholder rights is keeping the same percentage ownership. So if you own 50% of a company and the company decides to issue more shares, you have the option to buy those shares to keep that same 50% ownership. And then finally, as a shareholder, you can share in the assets upon liquidation. So if a company is closing, once those creditors are paid, you will get the share of your assets. When it comes to being a shareholder, we have to understand stock. And stock is sometimes scary just because people think it's complicated. It's not that complicated. We're going to walk you through just the basics in this chapter. We do have to understand some of the terms that go with stocks. So authorized stocks are how many a company can sell. So how many shares the company can sell. So it's authorized by your board of directors. You can sell this many shares of stock. Issued stock is how many shares have sold. So how many can they sell versus how many have they sold. And then outstanding stock is the difference between issued shares, so how many are out there, and your treasury stock, which we'll explain here in a little bit. Treasury stock is stock that the company buys back of its own shares. So outstanding stock is shares of stock that are sold outside of the company. We have par value stock, which means that the charter of the stock has assigned a value. Compared to no par value, which just means it has not assigned a value. And paid in capital, you have to understand, is the cash or other assets paid in exchange for this stock that is over its par or no par value. So I'll show you what that means. So if a stock is issued at par value, that means it's just issued for what that stock was assigned for. We'll record that we received cash and we issued common stock. Same price. If it's issued above par value, which normally it is, we'll get cash. The stock is still recorded at that par value. And the difference is going to what we call paid in capital in excess of par common stock. It's a long name. If it has no par value, first I want to show you, a lot of people put paid in capital, PIC, just to save some space. If it has no par value, again, we're going to record the cash. We're going to record the common stock as a credit. Again, this is the stated value times the number of shares. And the difference is still just going to be that paid in capital in excess of stated value. We're just identifying what type of common stock we have. Common stock. So it might be a situation where we don't get cash for stock, and that's fine. That happens, especially when you're starting off a business. We might get some assets instead, or maybe somebody provides a service for us. If that's the case, we're going to do the same type of thing, except instead of cash, we just record whatever expense it is or whatever asset we receive. We still record that common stock at par value, and then we're still recording that paid in capital. Paid in capital in excess of par common stock. I keep saying common stock because there's also an option to issue preferred stock. Preferred stock is still stock. It's just has a preference in who receives dividends first, is what you need to understand. So it usually costs a different amount. It might have a different par value, but the journal entries in essence are the same. We're going to record that we got cash. We're going to record that preferred stock, and that's going to be at the par value. And then we record paid in capital in excess of par, preferred stock for the difference. So the journal entries are all kind of basically the same. Just understand which type of stock you're recording. And then we have our treasury stock. This is, again, make sure you define this in your own terms so that you understand it. But treasury stock is corporations own stock that it buys back. So when we purchase the treasury stock, that is a debit. We're debiting our treasury stock, and we're going to credit our cash. Whereas if we have preferred stock or common stock, these are credit part of your stockholders' equity section. Treasury stock is a debit part of it. We'll show you what that looks like in the balance sheet at the end of this chapter. When we get rid of our treasury stock or we sell it after we acquire it, we're going to debit that cash we're going to credit that treasury stock for the amount that we paid. So whenever we buy it back, we have to come back to that journal entry when we purchased it. And then we're going to debit or credit the difference. So, and this can be based on whether we sell it above or below what we bought it for. So this debit or credit is going to go to paid-in capital from treasury stock. And then if we have a loss that's greater than our paid-in capital, here you'll notice that we did a paid-in capital, but if we have a loss that goes beyond what we already have in that account, then we have to take it out of somewhere else. So we're going to debit our cash again for whatever amount we receive. We credit our treasury stock for the cost of the purchase. We're going to go ahead and debit that paid-in capital in excess of par from your treasury stock. But that can only be up to the amount of your loss that you have available in paid-in capital. So let's say we have our paid-in capital account. It has a normal credit balance, and let's say it's $300. If our loss is $500, we can only take $300 out of this until it reaches zero. The remaining $200 is going to come out of our retained earnings. So that difference that we need to account for is coming out of our retained earnings, because treasury stock is part of that stockholders' equity section. Now let's talk a little bit about dividends. Dividends are the share of earnings from our stock that we pay to our shareholders, but dividends are not paid on treasury stock. That would be like paying ourselves. We don't want to do that because it's our money anyway. So dividends that we pay to our outstanding stock is made from our retained earnings account. So we need to make sure we have money in there if we're making any dividend payment. When we pay dividends, there's 3 different dates we need to acknowledge. The first is the declaration date. What this is the commitment to pay. We're committing to pay a dividend. We haven't paid it yet, but we will. And what's going to happen is we're going to record that cash dividend, the amount that we're going to pay, and record that liability with the dividends payable. Then we have our record date. The date of record is who owns that stock. So they'll say whoever owns the stock of it as of this day will receive the dividend. And then we have the payment date. That's the date that it gets paid. We're going to go ahead and decrease that liability. And pay the cash. Now here is the difference between preferred stock and common stock. Preferred stock gets the first shot at those dividends. It depends if they're cumulative or non-cumulative. Cumulative means that they are going to accrue over time if not paid. We have to understand the difference between cumulative and non-cumulative, as well as how to calculate this amount that's going to the preferred stockholders. So I have some calculations in here for you on how to calculate these dividends. And I'm going to show you how to do that. So if Hawk Corporation has 1,000 shares of 8% $20 par value preferred stock, the amount of dividends that those preferred stockholders get if dividends are paid are going to be 1,000 times 8% times 20, or $1,600. So if dividends are paid as such over 2001 year, then nothing, I had a bad year, and then 4,000. If that stock is cumulative, that means the preferred stockholders in that first year will get $1,600. The amount that goes to the common stockholders, as you can see here, is going to be what's left, or 400, because I started with 2,000. In 2022, we have no money to give. Nobody's going to get anything. Now, if this stock is cumulative, that's saying the preferred stockholders will get the amount from 2022 and the amount from 2023, or the 3,200, before the common stockholders get anything, and then they'll get the rest. If your stock is non-cumulative, that means in 2021, same thing's happening. In 2022, again, we're getting nothing. In 2023, that means that I don't have to account for those other years. So those common stockholders are only getting $1,600, and the preferred stockholders or the common stockholders, will get the rest. They'll get that $2,400, or the 4,000 minus 1,600. Because I do not have to account for those years that I did not pay those preferred stockholders. When I go ahead and record my stock dividends, because you don't always get paid in cash, sometimes you get paid in dividends, and that's same kind of thing where we just record stock dividends instead of cash. We're going to record the common stock dividend distributable for the par value, and then the difference is going to go to paid in capital. So that's if it is a stock dividend instead of a cash dividend. And then we're going to define that stock split. A stock split means there's no journal entry because there's no financial impact. And I'll show you what that means. If we have a 2-for-1 stock split and we have 500,000 shares, all of a sudden now we have 1,000,000 shares. It's still $10, or it was listed at a $10 par value. There's no financial impact. So now this is a $5 par value. So there's a stock split, meaning we have double the amount of shares, but then we lower that par value the same way. And it's 2-for-1. And then just understand how the balance sheet, the stockholders' equity section goes, especially pay attention to that, where that treasury stock falls and how it is less. Hopefully that helps. Let me know if you have questions.